Hey everyone, welcome back to the Penny Street Journal. Are you overwhelmed by the sheer number of investment options out there? Ever wondered what those three letters, ETF, actually mean and why they're so popular? Well, you're in luck. Today we're diving deep into the world of exchange-traded funds, or ETFs, a cornerstone of modern investing that can't be ignored. Stick around to the end because you won't want to miss this. Wondering how to dip your toes into the stock market without going all in on a single company? Enter ETFs, or exchange-traded funds, a versatile financial tool you can trade just like individual stocks. They give you the benefit of investing in a whole basket of securities all at once, often with a smaller bite out of your wallet in management fees. Take, for instance, the QQQ ETF, which mirrors the performance of tech giants listed on the Nasdaq. These ETFs offer a low barrier entry into the world of investing. They're straightforward, transparent, and you can trade them as easily as sending a text. However, remember that not all ETFs are created equal. Before diving in, you'll want to look at things like management fees and any trading commissions. Also, consider how quickly you can convert the ETF to cash and how well it aligns with your long-term financial goals. Ever wondered how an ETF magically appears on the market? It's not that complicated when you break it down. Think of it like assembling a team of all-stars from different sports into one super team. Here's how it works. The coach, ETF sponsor. First, a company decides they want to create a new ETF. They're the ones who set the game plan and choose the players or the securities that the ETF will include. The scout, authorized participant. The company then partners with a big financial player, known as an authorized participant. You can think of them as scouts who will actually go out and recruit the team members, or in this case, buy the individual stocks or securities. Draft day, creation. After buying up these securities, the authorized participant hands them over to the ETF sponsor. In return, they get a batch of new ETF shares, essentially forming the team that you can now invest in. Let's make it real. Say an ETF is supposed to mimic the Nifty-50 index. The authorized participant buys shares of all 50 companies that make up the index, and in the same proportion. They then trade these 50 shares for a block of new ETF shares. Trade window, redemption. And just like players can be traded, the process can go in reverse. An authorized participant can buy up ETF shares, return them to the sponsor, and get the underlying stocks back. This is known as redemption. Game time, market access. The back and forth of creating and redeeming shares helps the ETF stay true to its real value, especially because its price can move throughout the day, just like a stock. If the price starts drifting away from the value of its underlying assets, the authorized participant steps in to make adjustments. So the next time you invest in an ETF, you'll know the behind-the-scenes work that helps keep your investment on track. There are over 5,000 ETFs registered worldwide, with about 1,800 traded on the US stock market alone. To better navigate them, it is worth considering the main types of index funds, depending on the direction of investment. Index ETFs. This is the most popular and conservative form of ETF. They buy shares of companies included in stock indices and, consequently, duplicate their fluctuations. Investors are particularly interested in ETFs based on the S&P 500 index. This index shows the total dynamics of the 500 largest US companies. Essentially, by investing in it, an investor invests money in the American economy. Some prominent investors believe that the S&P 500 is the perfect investment option. In particular, according to Warren Buffett's will, 90% of the funds he leaves to his wife will be invested in an ETF based on this index. The advantage of this ETF is traditionally good profitability in the long run. For example, the S&P 500 index has risen 67% over 5 years and 205% over 10 years. As Buffett calculated, if he had invested $10,000 in this index fund in 1942, he would now have $51 million. Another plus of such ETFs is almost perfect diversification, as the investor invests money simultaneously in 500 companies from different sectors of the economy. Don't look for a needle in a haystack, Just buy the whole stack, advised investor John Bogle. In his opinion, there is no point in independently choosing shares of various companies. Most investors still fail to earn more than the average growth indicators of the S&P 500 index. On the stock market, there are 3 major ETFs tied to the S&P 500. Spider S&P 500, iShares S&P 500 Index, Vanguard S&P 500. There are also ETFs tied to other key indices. For example, the PowerShares QQQ fund follows the Nasdaq 100 index, which mainly includes technology companies. There are also ETFs that focus on the American Industrial Index Dow Jones, German DAX, Japanese Nikkei 225, Chinese Shanghai Composite, etc. Sector ETFs. If you think about any sector of the economy, there is probably an ETF that invests money in companies that work in that area. For example, there are index funds focused on agriculture, metallurgy, oil-producing companies, retail, financial sector, pharmaceuticals, and many other areas. You will find a link where you can read more about ETFs separated by sectors and investigate them. Let's take an example of when to invest money in them. Suppose you are convinced that the automotive industry will show good growth indicators in the coming years. People's population and income are growing. Oil is getting cheaper, so people will buy more and more cars. At the same time, you don't know the state of specific car companies, who is increasing production, who is in debt, who has promising technologies, etc. In this case, you can invest in the First Trust Nasdaq Global Auto Index Fund, a fund specializing in investments in car manufacturers. Thus, you will be investing money in virtually all key companies in the industry and diversifying risks. ETFs do not necessarily invest money in company shares. For example, investments in precious metals through index funds are quite popular. Such ETFs buy gold or silver, and accordingly, if the metal becomes more expensive, the fund's shares grow. Thanks to this mechanism, you can invest money in metals without facing the problems of preserving ingots, and without paying the difference for buying and selling gold or silver. Through ETFs, you can also invest money in other resources. For example, some of them buy futures contracts for oil and gas. Examples of such funds are the United States Oil Fund and ProShares Ultra DJ UBS Natural Gas ETF. Currency ETFs. Another lesser-known option for ETFs is currency. Such funds reproduce changes in currency quotes traded on the international foreign exchange market, relative to the US dollar or a basket of currencies. This is achieved through the use of cash deposits, such as holding euros or Swiss francs, or derivative financial instruments, such as futures and swap contracts, when forming such an ETF fund. The natural question arises if there is a desire to make money on exchange rates. Why not just open an account with a forex company? As experts explain, such ETFs allow you to earn money without withdrawing money from a brokerage account, for example, while there are no interesting options for investment. High-risk ETFs. Some index funds offer purely speculative instruments. For example, if there is a bearish trend in the market, investors can buy reverse ETFs. Their value increases if the base index becomes cheaper. The advantage of such funds is the simplicity of their use. You don't need to understand complex instruments that allow you to play on the decline. In addition, there are leveraged ETFs. They can double or triple profits. However, they also increase risks. Therefore, you should approach such instruments with special caution. As always, be sure to evaluate your risk tolerance, time horizon, account type, and specific goals when building your portfolio. ETFs and mutual funds both have their merits and often work best together in harmony. I hope this overview has provided a helpful high-level look at ETFs versus mutual funds. Remember, there's no one-size-fits-all answer. Your investment choice should align with your financial goals and personal situation. If you found this video helpful, please hit the like button, subscribe to the Penny Street Journal, and leave a comment with your thoughts or questions. Together, we'll continue to demystify the world of finance.